a Switzer regular. His stock selection tips always spark a flurry of emails from you at home. So tonight, we're giving you more of what you want. Roger Montgomery, author of Valuable and Independent Investment Expert, joins me now in the studio to share his top 5 buys of the moment. How are you, Roger?
I'm well, thanks, Peter. Thanks very much for that very kind introduction.
Mate, thanks. I stumbled. I put the great in there to make
the
it
great
sound
guru.
The great guru.
I said to you while we went out to the break, there's only one way to go. I don't want to be a guru. I can't predict. I should say this. I can't predict share price. I can tell you what things are worth, but I can't predict price.
Mate, let's get to the point now.
Yeah.
You got 5 good ones.
Yep.
2 not so good ones, and maybe a comparison. So let's get to the 5 good ones you like.
Okay. Well, what I want to do is I want to talk about good quality businesses. I rank companies. Let me say this. There's 3 things you want in an investment in the stock market.
Yep.
You want to buy a business that is of great quality. That means that it's got high rates of return on equity, little or no debt. Ideally, you want a business whose value, its intrinsic value, is rising. Many, many years ago, Benjamin Graham, who was, if you like, the mentor of Warren Buffett, said that in the short run, the market's a voting machine, but in the long run, it's a weighing machine. In other words, in the long run, prices tend to follow values. In the short term, that's not true. Yeah. In the short term, it's a popularity contest. Stocks go up because they're in fashion, they get dumped because they're out of fashion, whatever. But in the long term, prices tend to get it right. Witness Telstra. Telstra used to trade at $9 back in 1999, 2000, or early 2000.
Contest.
Popularity contest, peak of the internet bubble.
Yep.
The value of that business was closer to $3 or $4 than it was to $9. The value hasn't changed that much for Telstra over the last decade. Its value today is about $3.01. I value it around $3. The value hasn't changed, and it's taken almost a decade for the price to finally catch up with the value. Eventually it does. That's an example of where it's taken a really long time. More often than not, it takes 2 to 3 years, but eventually the price will catch up to the value. So what I'm interested in are good businesses, high rates of return on equity, little or no debt, and values that are rising. So their value is going to be going up. Okay. And most importantly, number 3, is I want to buy those at a discount to intrinsic value. Now, I'll very quickly tell you, I rank companies from A1 to C5 in terms of quality and predictability of performance.
So is there an A5 in this A1?
There's an I've brought in 5, my special yellow folder.
Okay.
Right, I've brought in 5 A1s, and I've given.
Guess, 5 A1s.
This is exclusive to the Switzer show.
Okay, we'll get on with it in case we run out of time.
Sorry, so 5 A1s and 2 C5s.
Okay, good.
All right.
Okay.
Now, the A1s are the businesses that we like.
Yep.
And ideally you want to fill your portfolio with these if you can buy them at the right price. Now, unfortunately, there are only a couple of A1s at the moment that are still below their intrinsic value. I haven't brought them in, but I'll tell you what they are. JB Hi-Fi is an A1 business that's below its intrinsic value at the moment. Yes, and its value is rising. Oriton is another one, both in the retail space, and a third one in the retail space as well. It's very close. It's about its intrinsic value. It's right on it. Nick Scali, the furniture retailer. Sure. So they're 3 A1 businesses that are trading at or below their intrinsic value. The ones I'm going to show you now aren't. They're a little bit more expensive, but they're still A1s.
Yeah, but if you buy them and hold them...
Well, let's have a look at Cochlear. Let's go through it. Yeah. So Cochlear is an A1 business. Its return on equity is estimated over the next 3 years to be about 39 to 40%.
And the CEO of the company's on this program next week.
Make sure you... I'll be watching. You send me an email to let me know that he's on.
No, you just watch the program.
Yeah,
but go on.
I can't watch every week. I've got to do this stuff for you, mate.
Go on.
Okay, so 39 to 40% return on equity over the next 3 years. Let me go through the intrinsic values for you. For this year, intrinsic value of Cochlear is $49.68, going to $54 and then to $63.
What's this current share price?
$70.41.
Okay.
So do you see what I'm saying? It's expensive even compared to what I think the intrinsic value will be in 3 years' time.
And it'd be hard to see it even get anywhere near that entry price you mentioned.
Well, here's the thing. People often tell me, Roger, you said it before, Roger, you can't find, there's nothing cheap, the market's expensive, what are we supposed to do? Well, I find that if you're patient, and if you're not in too much of a rush, and you wait for the good things to be cheap, something comes out of left field to make a good company cheap. If you take advantage of it, you tend to do pretty well.
GFCs can do that, can't they?
That's certainly been my experience. Okay, so Cochlear is one of them. CSL is another one. CSL is an A1 stock. It's trading currently at 35.64, and I've got its value at the moment at 33.55.
So it's very close.
Yeah, it's pretty close, but it's had that big run up, you can see, and it's up about 10%. Here's another one, REA Group, Real Estate. .com. Amazing business. The one risk for this business, of course, is that Google comes along and offers the same service to agents for free, and they've sort of indicated that they might do that. Be interesting to see how that goes. It's an A1, but very, very expensive. Well, actually not so expensive compared to its value, trading at $12.15, worth about $10 at the moment, and in a couple of years' time be worth about $12.50. Another A1, ARB Corp. It's trading at, where is it at the moment? Trading at $5.50, but its value is closer to $3.57. Having said that, though, in the next 2 years, the value will rise significantly and be higher than the current price.
ARB, tell us what it does.
Four-wheel drive parts and accessories, bull bars.
A bloke's business.
A very much a bloke's business, yeah.
Okay. Now,
although there are probably some women who'd be offended by that, but mostly blokes.
I can't deal with the fact that some women get offended. It just happens in the world.
Right. Okay. Pretty good. I'll leave that one to you. You can dig your own hole.
It's no problem.
Fleetwood is the next one. Now, Fleetwood's a business I've bought shares in a couple of times. I own shares in Fleetwood, so I need to disclose that.
Yep.
It is the second biggest manufacturer of caravans in Australia.
You're a road type, aren't you? You got bull bars.
Oh, mate, listen, I don't own ARB. I'm just telling you, giving you some A1s. This is an A1 business as well. It's one of the largest suppliers of mobile accommodation or villages for mine sites and the like around Australia. Fleetwood. So let's go through those again. ARB.
Give us the price on Fleetwood.
Fleetwood's value is about $7 in a couple of years' time. It's trading at $9.32 at the moment. So it's pretty expensive. It's part of that enthusiasm of the mining sector and mining services. Okay, so Fleetwood, ARB, realestate.com, CSL and Cochlear, high quality businesses, A1 businesses.